Good morning, friends. Do I have the speakers here? Balwan, Bansal, and Alok, Vasant? Yes.
Good morning, Sumit.
Hi, good morning, Alok. Good morning, Balwan.
Good morning, Sumit.
Good morning. Okay, so let's start. This is 12:05 by my watch. And though there are more people trickling in, but respecting everyone's time, let's start. So, good morning, everyone. I'm Sumit Pahwa. I'm a lawyer and fellow company secretary with 20 years of experience. Half of the experience on the corporate side, where I was head legal with Barclays 10 years back, and also served with G Capital. And I'm the founder partner of eMinds Legal, a leading corporate law firm, which is a 12-year-old firm, and now a co-founder of Complinity Technologies, which is India's leading compliance software, founded 6 years back. Complinity, as some of you may know, is India's leading compliance software, helping companies comply. So Complinity today is adding value to 800 plus companies, 10,000 plus users across MNCs, PSUs, listed companies, and medium and large companies. So this is part of the Compliance Wire series, where every month we are bringing in compliance topics, and what better a topic than the union budget today. And joining me are two experts in income tax, if I may say so. Mr. Alok Vasant. Alok is a chartered accountant and a law graduate with over 20 years of experience, and also holds an advanced diploma in international tax by the Chartered Institute of Taxation, UK. Alok is a tax litigator and accomplished advisor on tax structuring, inbound, outbound investments, M&A, international tax, etc. He's a founder director of Acupro Consulting, a leading finance consulting organization in India. And he has also worked with Deloitte, PwC, EY for more than a decade before setting up Acupro in 2010. So welcome, Alok, to this webinar today.
Thank you. Thanks, Sumit. Good morning, everyone. I wanted to start this webinar by just asking a question.
Yeah. Alok, I know you are eager and passionate to jump onto the stage, but let me just introduce Balwan as well, and then of course the stage will be all yours. Yeah. So Balwan, friends, Balwan is a rank holder chartered accountant, a registered valuer with IBPI, law graduate, and a certified CFA from US with 18 plus years of experience. Balwan is also the co-founder and director of Acupro Consulting, which is a leading tax advisory firm in India with 100 plus professionals. And Balwan also has worked with Deloitte, EY before founding Acupro 12 years back. Other than that, Balwan is also a startup enthusiast, and I myself a recipient of Balwan's communication on startup and funding and all that. So he has a very entrepreneurial bent of mind, encourages innovation and continuous learning. So Balwan, startups and funding is very close to my heart as well. And I think you do a great job in that, along with, of course, the hardcore tax expertise that both of you bring to Acupro. So welcome, Balwan, to the table.
Thank you so much, Smith. Thank you for a warm introduction. Thank you.
Pleasure. I want to run Alok, before you wanted to start a very small poll on the audience, because so that all of us can understand what is the complexion of the audience. So just a small poll, friends. I wanted to launch. Are you, just identify yourself, are you a tax professional or a CFO, finance professional, or a company secretary, lawyer, MD, CEO, entrepreneur, student, consultant? I know, there could be 10 more categories, but whichever best describes you, so that the speakers get an idea of how much technical they can or they should go. I'm not a tax expert myself, but I know how technical budget and tax discussions can be. So just so that everyone is on the same page and we all understand what the speakers bring to the table. Okay, so while people are filling up the poll, Alok, you can you wanted to ask a question to the audience. Maybe I'll you can start, and I'll just end the poll in a moment. But of course, inviting you to start.
Okay, so thank you, Sumit, for such flattering introduction. So I just completed 25 years of my professional life. So great to have this opportunity to do this webinar with you. Tax has always been very close to me. This time Unfortunately, I wasn't too well, but still I thought this is something which is my passion and I should go and deliver on this.
No, Alok, really appreciate that. And to tell the friends a little bit on the personal note, if I may take the liberty, Alok had a minor surgery just 2 days back, and is still not fully recovered. Just discharged yesterday. All is good, but this is his commitment to the webinar that he's right there joining. So thank you, really, Alok. No words to explain and express gratitude for that. Yeah, thank you.
Absolutely my pleasure. This is to address this August gathering. So I wanted to start with a very, very awkward question. Has anyone ever seen an elephant hatch an egg? Right? So this is a very awkward question. And also, has that egg ever been golden egg? So this was my question. If you have any comments on this, feel free to put it on the chat box. But I think this is, I haven't seen any elephant hatch an egg. But I think this is what there is an widespread expectation whenever the budget is round the corner, that something great is going to happen. Yeah, something great is going to happen, something out of the world is going to happen in a budget. And this is with this expectation that people are buzzing around, looking around, or what is it there in it, inform me and all that. So this is how people wait for the budget, the news, the media, everyone creates an hype that budget is going to change our lives. But let's understand, what is this budget? Budget is a balance sheet which the government gives that, okay, these are my resources and this is how I will go and spend them, right? And in that context, they will say that, okay, I will collect so much from you in form of taxes, in form of loans, in form of other revenues, and I will spend on these areas, right? So it's a balancing exercise, right? So some people gain, some people think that this is no good, right? So I think with that kind of a background, let's look at what has happened in this budget, especially I think this year being the election year. This budget had a lot of expectations, especially from the middle class, right? So people felt that there were buoyant tax collections. There were good indicators in the economy. We had already seen the worst of the pandemic, and it was on the way in. Can you see my screen, right, Sumit?
Yes, Alok.
Yeah, just a minute. Yeah. So the economic indicators were all good. There was a huge increase in direct tax collection, increased FDI inflow. India is the largest growing economy. And obviously, there was this COVID uncertainty, which has waned down. And I mean, there was this uncertainty which also came in the last week of December, but thankfully, things haven't taken a bad turn. So the expectation was high. Now, with this backdrop, I think one natural expectation was that the tax rates would be rationalized, right? If you have higher tax collections and the government has higher tax revenues, then the benefit should be passed on to the people, and they should be taxed at a lower rate. Some changes have been made to this effect. Obviously, we all want more from the government on this, but the government has made a few changes here and there. Corporate taxation has been left pretty much untouched. No changes in the tax rates for corporates, except that they are promoting startups, they are promoting manufacturing, and that's the reason they have increased the sunset clauses for those companies by 1 more year. And I think this will go on for a couple of more years. I have no reason why they will bring a sunset on this sector. very soon. So that's how the whole the focus of this budget has been largely on uh, plugging certain loopholes, uh, removing hardships, improving the business environment, promoting innovation, and above all, increasing tax base. And I think the biggest focus has been in trying to simplify the taxation structure, which means to do away with the numerous deductions that one has to claim. And they want a simple structure where people earn money and pay taxes on the basis of that. They're not trying to benefit any particular industry, say an insurance company, by giving a leverage, in the sense that if you pay premiums to an insurance company, you get a further deduction and all that. That all thing has been uh, taken away slowly. And I think in this budget, the intention is very clear that we will not want to give you any deductions as such. We will try and uh, rationalize the tax slabs, give you more money in your hands, but don't come and claim deductions. Just a couple of other parameters. There is this fiscal deficit target of 5.9 to be achieved. Then the government, as I said, the government hasn't rolled out too many SOPs, especially for the middle class. Yes, for people in the taxable income bracket of 7 lakhs, they have been made fully exempt from taxation. And I think the major thrust of this budget is the capital outlay, which is proposed to grow by 33%, which is 10 lakh crores. And I guess the government is looking at creating employment opportunities by doing this. And that is what the need of the hour is. So they're using all this money, whatever they collect, to create infrastructure in the country and spend. And this year being the year in which India has assumed G20 presidentship, I think a lot of activities and conferences and events will take place across the country. And for that, the government is already spending huge amounts of money, huge capital infrastructure has been built, and we can all see it in Delhi as well. So I think the focus is to increase the capital outlay, and which will create more employment opportunities and in turn benefit the industry. I think I'll just to break the monotony, what I'll do is I'll also ask Balwan to pitch in between and take up some topics. I'll take few of them. And as Sumit mentioned, I haven't been able to put too much time in this budget exercise, in the sense analysis of the budget, but I am relying on Balwan to dole me out on this, or bail me out on this. And Balwan being a champion in the startup space, I think he's the best person to look at some of the provisions which have impacted the startup and especially the investments into the startups. Over to you, Balwan.
Thank you so much, Alok. So basically, I'll start with what has been done to improve the business environment, right? As you mentioned that the major focus of the budget was improving business environment, reducing compliance, right, increasing the tax base, right? So what has been done for the small businesses, that the focus of the government has been that if the payment cycle in the businesses can be improved, right? So government has identified a problem that the companies faces a lot of problem, working capital problem, because their customer doesn't pay in time. So under GST law, they have brought a provision that if the customer doesn't pay within 180 days, it has to reverse the credit. It has to reverse the input tax credit, and it can be availed only when the payment is made to the vendor. Similar provision has been inserted in the Income Tax Act now. So what has been done is Section 43B has been amended, and what Section 43B says is that the deduction is allowed only on actual payment basis. So it says that any sum payable by the assessee to a micro or small enterprise beyond the time limit specified in Section 15 of MSME Act would be allowed on actual payment basis, right? So if the payment is not made within the due dates, within the date specified in Section 15 of MSME Act, right? So deduction would not be available, on accrual basis. It would be available only on payment basis, right? So now the question arises: what is micro and small enterprises? What are the timelines that has been specified under Section 15? What is the what would happen if the payment is made within the timelines, right? Whether that payment would be allowed within the whether that expense would be allowed as per the accrual method of accounting, or it would also be allowed on cash payment basis, right? So these are the questions that we would like to I would like to discuss on, right? So first is like, what is micro and small enterprise, micro or small enterprise, right? So that has been defined in MSME Act. So micro enterprises are the enterprise which has invested less than 1 crore of rupees in plant and machinery, or the turnover is less than 5 crores in a financial year. So those are the micro enterprise, and similarly small enterprise are the enterprises which has invested less than 10 crores in plant and machinery and turnover is less than 50 crores. So this is micro or small enterprise. And what is the timelines as per Section 15, right? So Section 15 says that if there is a contract between there is a written contract between the buyer and supplier, right? So the payment has to be made within the due date mentioned in the contract, right? But this due date cannot be more than 45 days. Cannot be more than 45 days from the date of receipt of services or from the date of receipt of goods, right? So if the payment is not made within the date within the date mentioned in the contract, right, that which cannot be more than 45 days, so the expense would be allowed only on actual payment basis, right? Similarly, if there is no contract, then the time period is 15 days from the date of receipt of goods or service, right? So this is the timeline that has been mentioned under Section 15, right? So so now the question arises, if the payment is made within the time limits, right? So whether the deduction would be available on accrual basis, or whether the deduction would be available in on actual payment basis. So I have written a question, right? So let's say Mr. A, like this is a balance sheet of or like extract of a statement of creditors, right? So how like in which year the deduction would be available? Let's say these are the expenses incurred in financial year 22-23, right? And this is the liability as on 31st March 2023, right? So the expense is payable to Mr. A 200 rupees, right? Say due date is 20th March 2023, right? But the actual date of payment is 19th April 2023. So what should be the, in which year the deduction should be available? So like everybody can write in the chat box. So I'll wait for the answer and then move to the next question, right? So where Mr. B is required to be paid 300 rupees. Due date is March 20th, 2023. Sorry, April 20th, 23. But actual payment is made on 19th April 2023, right? So in the first case, there is a non-compliance, right? In the first year, there is a in the first case, in case of Mr. A, there is no non-compliance because payment was to be made on 20th March, but actual payment is made on 19th April, right? So if there is a non-compliance, then the deduction would be in the year of payment, right? So the deduction would be available in financial year 23-24, right? But see the example of Mr. B, right? Where payment due date is 20th April, but payment is made before that, right? 19th April, right? So in that case, deduction should be available on accrual basis, right? So basically, this deduction would be available in the financial year 22-23, right? In the next cases where Mr. C and Mr. in the case of Mr. C and Mr. D, there has been a non-compliance, right? If there is a non-compliance, then the deduction would be available in the year of actual payment. So in case of Mr. C, the deduction would be available in financial year 23-24. And in case of Mr. D, the deduction would be available in financial year 24-25 because this payment is made in financial year 24-25, right? So
I must say, Balwan, just cannot stop myself that this is a very good change because the definitions of small, micro and small is quite enlarged, and this will help them to receive monies from these larger corporates in time, because this, I think they've hit the nail. If companies are not, means if they're disincentivized, if it is expenses being disallowed, if the payment is done beyond time, I think it's a very welcome change. And very beautifully articulated, Balwan. I'm just conscious of the time, Balwan. While I know, it almost looks like a master class. We can deep dive, but with the budget and the and the large provisions that you have to cover, I think you if you can be a little more fast, because I know you have a lot more to say and cover. So we are all waiting for that. And for the audience, if you have any questions, please put it in the Q&A box. You can keep putting it. We'll take the question in the last 15 minutes or so. So Alok and Balwan will have 45 more minutes to cover the whole, budget and every, but very welcome change. Let me just compliment.
Yeah, just one small clarification on the illustration for the audience. I mean, this is only an illustration where we have taken March 31, 2023 as the date. But this provision applies from assessment year 24-25, which means you just need to skip 1 year here and then read the example. It will be applicable in that fashion.
Right.
Balwan, is it right?
Yes, because this is applicable from the next year, March 24. So like March 24 was not taken because difficult to get 24 in mind. But anyhow, so I will tell, like I would like to say that like what Sumit says, that it's a welcome change. So it creates two kind of opportunity for the professional. One is that there are many MSMEs who has not taken registration under MSME, right? So they should go and take MSME registration. Second, communication is very poor in MSME registration. So we don't go and tell our customers that we are MSME registered, right? So I think this should be done, and company should build a control that they take these registration from their suppliers. So I'll move to the next point, which is on section 44 AD and 44 ADA. So section 44 AD and 44 ADA is on the fact that a smaller business whose turnover is less than 3 crores in business can avail presumptive taxation. Similarly, a professional can take the benefit of presumptive taxation if its turnover is 75 lakhs, right? So earlier these limits were 2 crores and 50 lakhs simultaneously, respectively, right? So the limit from for section 44 AD has been increased from 2 crores to 3 crores, and limit of section 44 AD has been increased from 50 lakhs to 75 lakhs. So what is section 44 AD and 44 ADA? So 44 AD talks about that that eligible person is eligible person engaged in eligible business can opt for presumptive taxation, right? So it can offer its income. It can offer 6% of its gross receipt as income if the income is received through banking channels, and it can offer 8% of the receipt as income if it is a if the receipt is in cash or any mode other than banking mode, right? And what is the eligible business? Eligible assessees are you know this individual HUF partnership firms other than LLPs, right? And eligible businesses, all businesses, right? Except except you are in agency business where you get commission, or some other business like play, playing on cartage, carriage business or transportation business, etc. Right? So otherwise, every business is eligible under section 4480 and 4480. So there is a like another point is there is a 5-year rule, right? So if somebody was eligible under section 44AD and they don't claim 44AD in a year, they cannot come back to this in the next 5 years, right? So this is the rule that has to be taken care while deciding whether you want to go for your client on 44AD or ADA, right? So what is the benefit? Benefit is that you can it's a simple process, and there is no requirement of maintaining books, or there is no requirement of getting the audit done. So this is a welcome change for the industry, at least.
So one small addition to what Balwan mentioned. The increased limits are only applicable if you receive 95% of the consideration in other than cash. So the increased limits are only applicable in such a case and not otherwise. So this is again a digital push that the government is wanting to do. So if you continue to receive more in cash, then the limit remains at 2 CR and 50 lakhs only.
Right. And because this digital infra has improved so much, right? So we are the largest country in the world, which has the maximum number of digital transactions now, right? So government wants to push it more, right? So let me move to charitable institutions, right? So charitable institution, there are some loopholes have been plugged, right? So what has happened is that if a donation passes through several charitable institutions, right? So 15% accumulation is done at each level, right? So how does it work? That if a charitable institution gets 100 rupees, right? So they can it can save 15% and spend 85%, right? So this is the current law, right? So if this 100 rupees passes to different charitable institutions, right, and each save 15%, so the amount that is required to be spent gets reduced substantially, right? So if you take this example, so if charitable institution get 100 rupees as donation and it saves 15 rupees and give 85 to B, right? And then B saves 15%, which is 12 rupees 75 paisa, and give 72 rupees to C. Similarly, C saves 10%. And at D level, D is required to spend only 52 rupees, right? So this was a loophole there in the law, right? It has been plugged now. So what it says is that the intermediary charitable institution shall not be eligible to accumulate this 15%, right? So in this case, this institution A is required to pass 100% to B. So it won't get the deduction for 15% if it passes the donation directly to the other charitable institution. So this is a provision where this loophole has been plugged. Next is important point for the professionals, so that people don't miss that this form 9A and 10 is to be filed 2 months prior to the filing of tax return. So what is this section? What is this form 9A and 10? So basically, if the charitable institution is not able to spend the money within the year, they can accumulate it for 1 year or 5 year under respective sections of respective clauses of section 11, right? So they are required to file this form 9 or 9A, depending on what kind of what clause you are using to accumulate the income, right? So what happens is that today this form 9A and 10 is required to be filed along with the return, but before and after the tax audit is done, right? So tax auditor faces problem that it is saying that company has claimed has accumulated income, whereas the company has not filed its form yet. So what has been proposed now is that this form 9A and 10 is required to be filed before 1 month before the tax audit. So if the due date for tax return is 30th September, right, tax audit has to be done by 31st August, and like 1 month prior, which is 31st July. So form 9A and 10 is required to be filed by 31st July. So every professional has to take care that these forms are filed before 31st July. Now let's come to the startup section, right? So there are some tweaks in the startup section that has been done, right? So startups, one is like startup has to get registered with the government of India, right? So, and then if it wants to claim the exemption under section 80IC, it is required to get registered under section 80IAC, right? So it has to take an approval from Interministerial Board of Certification, right? So what has been provided till date is that if there is a change in shareholding of more than 51%, then section 79 says that the losses cannot be carried forward, right? But there is an exception in case of section 80 IAC registered startups, that they can claim the carry forward losses in the first 7 years of their incorporation, right? So now through this budget, this time limit has been increased from 7 years to 10 years. This is a small change. This is a small benefit that has been given to 80 IAC registered startups, right? And the second is that, as Alok mentioned in the introduction, right, that some time period has been extended for 80 ICA registered startups, right? So earlier this limit was up to March 2023. Now this has been increased to March 24. So whatever companies gets incorporated next year, which is like financial year 23-24, they would also be eligible to get themselves registered under 80 IAC. So this is a small change on startups.
Balwan, one on the previous slide, one question, if I may ask or interject you right now, although certain audiences also are asking certain question, but I have the privilege to be the moderator, so I can interject as well the speakers, right? So, but very important question here. Wasn't this 10 years already there? I mean, this change of 51%, okay, it's a new provision, but wasn't this any 3 years out of the 10 years, or it has 7 moved to 10 now?
So,
yes, Balwan.
So 10 year, like in the first 10 years, you were eligible to claim this deduction, right?
Right.
So 7 years out of 10, right?
So it was, I mean, Sumit, the provision is that you can claim a deduction of profits for 3 years out of 10 years.
Right.
When initially this section came, it was 3 out of 7 years.
Okay, but
that was increased to 3 out of 10 years. Now to bring it pari materia, even section 79 the period was increased from 7 years to 10 years.
Oh, okay. Understand.
That's the small change in 79 that they've done.
Okay. And also this certificate of interministerial board of certification. Now, for example, a startup getting registered with DIPB, that's fairly easy. That that process is online, and I think there are more than 50,000 startups that have got registered, etc. But I was reading somewhere that less than 1% of those startups have received this interministerial board of certification. And I have myself personally experienced, professionally experienced that this certificate is very hard to get. There are so many to and fro's from the department online, and it's very difficult to get this tax exemption certificate. So any experience you would like to share over there?
Sumit, you're right. I mean, this has been our experience as well. Getting this kind of a certification from the interministerial board is not easy. Though we've got one, but what the board is looking at is a real cutting edge technology, a real innovative product, and then only they're willing to give any such kind of a certificate. So to my mind, this section is largely a, in letter, and a lot of people try and avail this or try and seek a registration here, but fail to do so because they are unable to clearly explain how is their product very innovative, or how is it different from competition, and what is it that it's going to do, which is something very phenomenal. So
yeah, that's exactly what our experience also is. While it looks great on the section that startups and 3 years 100% deduction, etc., but to get this certificate, if it takes so much of procedure and forget the procedure, the chances are very, very less of getting this. It then remains in letter. And that's where I think the government should loosen up their purse strings to effectively, because what is innovative, what is cutting edge, it's so subjective. To the taxman, the startup may not be cutting edge, but to the founder, I mean, the startup is his darling, and he may be doing a wonderful job anyways. So I thought I'll pick up your brain on that. Yeah, okay.
Yeah.
So
Right. And in fact, Sumit, this is being given to the companies which has patent or patented technology, etc. But like general software companies, etc., are not eligible under this, right? So that's our understanding from the department, that these software companies are not generally covered under this ATI AC.
Sure. Thank you, Alok and Balwan.
Yeah.
Right. So next I'll touch upon this angel tax, right? So what has happened is that there was a lot of issues earlier under angel tax, right? So but the government brought that exception that if it is a registered startup, then capital premium received would not be taxable. Premium received from premium received on issue of shares is not taxable, right? So section 56(2)(7)(b), which is a section of angel tax, says that if you have issued shares at premium, and premium is not justified by its fair market value, then the premium gets taxable, right? So but there are few exceptions that were brought in, right? So one was that if it is a registered startup, then angel tax is not applicable, right? If the money is received from AIF or non-resident, right, then angel tax is not applicable. And if the shares are issued at fair market value as per valuation report, then angel tax is not applicable, right? So now it has been proposed that from this list non-resident shall be taken out, right? So now only exception that would be available would be to, one is registered startups, second is to AIFs, and third is if the shares are issued at fair market value, right? So these would be just three exceptions that would be available, right? So what is the impact? So it looks very simple, right? So if you are a registered startup, then premium would not be taxable, right? What I've seen is that this is going to create a lot of problem for grown-ups, right? So the startups which has grown to a revenue of say 100 crores, right? So if you are achieved that target, achieved that limit, right? So you are not eligible to get yourself registered as startup, right? And if you receive money from non-resident, in case of generally grown-ups, right? So this money generally uh, received from the foreign companies or the foreign venture capital funds, right? So what is going to happen is that if a grown-up or a grown-up startup receive money from a non-resident, which is generally the case, would not be able to get the benefit of this exception, right? And there is a anti-dilution right which generally a foreign investor takes in SHAs, right? So in what is anti-dilution right? Anti-dilution right is that the investor is eligible to get more number of shares, right? If there is a down round in the future, if the shares are issued at a price lower than the lower than the existing share price, right? So what is going to happen is that take an example, shares are issued at 100 rupees today, right? And there is a down round in the future, right? So what happens is that to protect that down round, so investor get a right that it would get more than one share against 100 rupees that he has given to get one share earlier, right? So how it is being done till today is that the valuation report is generally at a price say less than 100, which generally 70 75 80 85 rupees, right? So there is a margin of say 20% 20% or so in the valuation report, right? So if there is a down round, so this 20% 20% margin protects the investor, and investor can get like up to this 20% more shares because the fair market value is lower. But what is going to happen in the future is that these company and this company would be required to have the valuation equal to the price at which shares are being issued, right? So if the valuation is lower than the issue price, then the difference would get taxed, right? So it would be very difficult in that situation, right? So if the face value and issue price is same, then company would not be able to give anti dilution right. So this is going to be a big issue in the industry, right? So the foreign investor would not be able to get anti dilution right in the future. So this is a big change that is going to impact FDI in the country.
So I think just to add to what Balwan mentioned, we already have a provision under the FEMA or the Foreign Exchange Management Act that when you issue shares to a non-resident, those shares should not be issued at less than the FMB or less than the fair market value. But there is no stipulation in FEMA to state that you cannot issue them at a higher price. You're free to issue them at a higher price. But with this kind of a provision now coming in, you have no headroom. You have to actually issue them at the FMB only, right? And what I foresee is that this is going to create more litigation in future. The intention always was that if it's foreign money, if it's coming from outside India, you have KYCs, you have everything. You should allow it to come at a higher valuation as long as it is not less than the FMB. You should allow it to come. Now, if you want to tax that excess money, then that's going to create a problem. Because why are we stopping the foreign capital? If someone wants to pay more for a share, which is worth 1,000 rupees, and he wants to pay 1,200 for that, India should welcome that, right? If you have a KYC issue, you can plug that, you can use Section 68, you can make amendments if required in that Section 68. But why get into this kind of a thing? This is giving a handle to the tax officers that if you get any money in premium, they will go and challenge the valuation report. they will try and try and pick holes in the valuation report, because most of the valuation reports are based on projections, right? And projections are given by clients. And we've seen that a lot of times these projections don't come true. And the tax officer often picks up a case after 2 years or 1.5 years. And then he will say, okay, you had projected that the company will have a turnover of 100 CR, but it has a turnover of only 40 CR, right? Therefore, I reject your valuation report. Right. So, I mean, all those kind of things, I mean, you will have some courts to jump in, protect you and all that, that valuer is not an astrologer. As long as a valuer has done his work diligently, his report cannot be challenged. But this creates an unnecessary harassment for taxpayers.
Yeah, I also want to comment here, Alok. Very true. Even the founders don't have crystal ball when they make projections. They go with all their might and spirit to achieve that. But there are stretch goals, and they may not be able to achieve certain things. So I think fair market value is all a matter of, it's like a price of a share, which should be left in the hands of buyer and the seller, or the company and the investor. Why should the tax, again, assuming anti-money laundering and all those things are taken care of, but I don't think the government has any business to say that, okay, the startup value is this, because one, they have limited understanding, and second, the valuation itself is the art and science, and third, same startup can be valued X by some investor and 5X by the other, and so many other variables involved. So it's very difficult to say the real value is 1,000 or 2,000. We have seen even listed companies, dropping 50% of their valuation overnight. Doesn't mean intrinsic value is intrinsic value. So, to that extent, government should be away from the valuation reports, but and not really challenge, because they are anyway so subjective.
Right. So I think this will come up for a lot of debate in the next few weeks. And hopefully the government will see the light on this and make some changes here. Okay, so I'll just take over the baton from Balwan.
Yeah, I'm just conscious of the time, Alok.
I'll quickly finish it in next 15 minutes.
Yeah, no, although the questions, we have a few questions, but still, I think, you can take, but yeah, 1:30 is a time. So, pace yourself accordingly. Yes.
Right.
Yeah.
So I think the biggest focus of the government has been to simplify the tax structure for individuals in this particular budget. And they have gone ahead to do that by saying that the new regime should be the default regime. They have absolutely discouraged the old regime. And I'll tell you how. So what they've said is that we will now have 5 tax slabs under the new regime. So up to 3 lakhs, there is no income tax. From 3 lakh to 6 lakhs, there's 5% and 10% for every gap of 3 lakhs. The rate increases by 5%, except that above 15 lakhs, the rate is 30%. So this is what the government has said. And one may also see that government has not made any change in the old regime slab rates, right? So the old regime, if people may remember, the basic exemption limit is 2,50,000. It has remained the same, right? And then the tax rates, whatever were there, they have remained the same. So beyond 10 lakh, you have a 30% tax rate there, right? So it's a clear indication that the government doesn't want people to follow the old regime. Government wants them to come back to the new regime. And this had been introduced 2 years back. The response hasn't been very good. People generally haven't adopted the new regime. But I think with this step, people will take a look as to what is better. And I think the other thing which the government has done is that they have changed the rebate under Section 87A. And this change is only for the new regime and not for the old regime, which means that if you have a taxable income of 5 lakhs under the old regime, then you don't pay tax. But if you have a taxable income of 7 lakhs in the old regime, you pay tax. While in new regime, if you have a taxable income of 7 lakhs, you don't pay any tax because the rebate is up to 25,000 rupees there, right? So some of the basic pros in the new regime is basic exemption limit has been hiked from 3 lakh to 2,50,000. 5 income tax slabs, rebate under 87A has been enhanced to from 12,500 to 25,000 rupees, and which is only for the new regime, not for the old regime. One good thing that the government has done is they have allowed standard deduction to the salaried class of individuals, which means they will get additional 50,000 deduction, which was not there earlier in the new regime. So effectively, up to an income of 7,50,000, there will be no tax. So anyone earning income up to 7,50,000, he will not have to pay any taxes in India. The other deductions which are available in the new regime are only employer contribution to NPS or the National Pension System. And if someone is employing people, then a deduction on account of the salaries that it pays to its employees, which is under Section 80 GHAA. Other than that, there are no deductions which are available to individuals who fall under the new regime. The other sweetener that the government has added is that the highest surcharge for people opting for people being in the new regime is 25% as against 37%. So if you would remember that anyone earning an income in excess of 5 CR in a year, the maximum marginal tax rate was 42.744%. Now that maximum marginal rate has come down to 39%. So this benefit is only to people who are under the new regime and not to people who are under the old regime, right? So that this itself, by reducing the tax rate by 3.74% roughly, so 42.744 less 39%, which is 3.744%. Individual earning 5 crores can potentially save 18.5 lakh rupees on taxes under the new regime, right? Now, what are the minuses for under the new regime? So if someone's claiming an LTA, someone's claiming a house rent allowance, children education, not much though, professional tax, self-occupied house interest, this could be significant. Additional depreciation, mediclaim premium, any ATC payments, donation, etc. Those deductions are not available under the new regime. This is only available under the old regime. What we have done is we've done a small illustration wherein we have seen what is the tax at different levels of income under the old regime and the new regime. And you would see that till the income of 17 lakh 50,000, it is the new regime which is more beneficial, right? Only if you have a housing loan to pay and you're claiming interest on that, can there be a situation where old regime may be better. So, and as I mentioned, the new regime has been made the by default regime, which means that if you want to stick to the old regime, you have to go and opt for the old regime, and you have to do this or you have to opt this every year. And it's not that you opt it once; you have to opt for it every year. So by default, you will be considered to be falling under the new regime. But if you choose to opt for the old regime, then you have to make an election for that before the filing of tax return. So the clear indication is that the government wants people to move to the new regime, right? Some other small changes that the government has done. This is again part of plugging the.
Alok, there's one audience question on the same topic, so I'm inclined to ask that. Deepak asked that, what about tax benefits for food card, I think those Sodexo coupons like or employer PF and lease car under the new regime?
So lease car is a perquisite. So that remains the same. That remains the same. Food coupon again is a perquisite. That remains the same. What is denied is only deductions.
Right.
What is denied is only deductions. So you claim a deduction for leave travel allowance, you claim a deduction for HRA or children education, hostel allowance and all that, 100 rupees. And those are old deductions which are there. Or professional tax. So in states where there is a professional tax, you claim a deduction for the professional tax that you pay. I think the significant here is HRA and self-occupied house interest.
Right.
These are the two significant payments that people make and claim deduction. So if people have that in their scheme of things, then they should really look to choose between the two regimes.
Right. So the perquisites remain same, is the deductions that are being sort of
Correct.
withdrawn in the new regime.
Correct. So perquisite is an addition to the income. It's not a deduction.
Right.
So this anomaly has been corrected in this budget. A lot of people, what they used to do was they used to claim deduction under section 24B on account of housing loan, right? So suppose I have a self-occupied house and I've taken a loan to buy that house and I'm claiming deduction of 2 lakh rupees under 24B and setting it off against my salary income, right? And then 10 years down the line, I go ahead and sell this house, right? So what people used to do was that they used to say that, okay, I had bought this house for 1 CR and I have incurred an interest expense over the last 10 years of another 25 lakhs, right? So my cost of acquisition is 1 crore 25 lakhs. I will take indexation on this, right? And therefore, accordingly, I'll compute my capital gains. So there was a double deduction which was happening or people were claiming. And so this has been put to rest by making an amendment. And they've said that if interest paid on borrowed capital was claimed as a deduction, then that will not be included in the cost of acquisition or improvement for computing capital gains. A small amendment in section 45 5A and 194 IC by government's own admission. This was a miss in section 45 5A, wherein they had only mentioned the word cash and not amount paid by way of check, draft, or any other electronic mode. So some people were taking a position that if I get any amount in my bank account, then that is not taxable, which was taking things a little too deep, right? So, and though the TDS section did cover both the categories of payments, whether in cash or in a bank account. So this anomaly has been corrected, but the good thing is that this has been corrected prospectively and not retrospectively. Now, this is another significant change, section 54 and 54F. So you may be aware that section 54 gives you an exemption from capital gains if you sell a residential house and you buy another residential house, and the capital gains will be exempt if you invest the entire capital gains into buying a new residential house, right? So there was no limit which was mandated there. So you could have sold a property worth 80 crores and suppose you have a capital gains of 60 crores because you may have inherited that property from your legal heirs. And you could have gone ahead and invested that 60 crores in buying a huge house. And you could have saved taxes and not paid any taxes on that. And similarly, after 3 years, again, you could have sold that property and again utilize the gains in this manner. So, that was something which was being done. Again, 54F deals with a situation where people sell capital assets other than a residential property, say shares in a company, and then utilize the proceeds to buy a residential house. So in that case, also, if the proceeds are utilized, then also the capital gains which result from the sale of that capital asset of shares in my example will not be taxable, subject to certain conditions that you should not have two houses and all that. So now the government has put a restriction and it has said that the new house that you buy should not have a value exceeding 10 CR. And if it has, we will ignore the amount exceeding 10 CR and we will tax you on that amount. Right? So the maximum capital gains exemption that one can hope to avail is only 10 CR. Right? And in 54F, there is proportion. Capital gains exemption is on a proportionate basis because the requirement is to invest the sale proceeds of the capital asset and not the capital gains, unlike in section 54.
Alok, in this case, if the capital gain is more than 10 CR and suppose it is 15 CR, so and if 15 CR is invested in a property, is it that the 10 CR will be exempted and the 5 will not be, or the entire 15 will be?
Yeah. So 10 CR will be exempted and on 5 CR you pay the taxes.
Right. So it has limited the capital gain exemption to 10 CR.
Right.
Even if the cost of the property is more than 10 CR, it will be capped to 10 CR to that.
Absolutely. So there is no restriction that you cannot buy a property exceeding 10 CR. You can always go ahead and buy that. But we will give you exemption limited to 10 CR only.
Sure. There are questions saying, can you please repeat the taxability for inherited property?
So for inherited property, the cost of acquisition is the cost to the previous owner or cost in the hands of the previous owner. And if in case the property was held by the previous owner as on 1/4/2001, then either the cost in the hands of the previous owner or the fair market value or the stamp duty value as on 1/4/2001 of that property. That is the cost of acquisition. Right. Then you index it to today's date and then compute the capital gains by reducing this indexed cost from the sale consideration. So that will be the capital gains. And if you invest this entire capital gains into a new property and that new property, then you will not be taxed unless the capital gains amount itself is more than 10 CR.
Right.
And the property that you buy is more than 10 CR.
Understand.
Okay, I know we're running out of time, Sumit, but just a quick few things. These are just one-liners.
Sure. No, but let me compliment. As far as I'm thoroughly enjoying your session, more so because it is the way it is going right now, and I'm sure audience, please give us a little bit of cheer on the chat box. It looks more like a master class, more like you're teaching. Rather than it being at a very 15,000 feet level. So I'm thoroughly enjoying and really learning a lot. So go ahead, Alok. Yeah. I'm sure the audience is also picking up nice cues. So an audience, any feedback or anything, please Q&A in the Q&A box, and anything that you'd like to tell the speakers or anything else, feedback or anything, please put it in the chat box as well. Yeah.
Right. Okay. Again, a loophole is being plugged by making an amendment in section 9. A couple of years back, I think in 2019, if my memory serves right, they had brought in a provision that if a non-resident receives a gift from a resident outside India, that would also be considered to be taxable in India because it will be deemed that the gift accrues or arises in India. So what was happening was a resident in India would go outside India and make a gift to an unrelated party of say 10 CR, right? So in the normal situation, such kind of a gift would get caught under the web of 56(2)(10), right? Because it says if you give a gift exceeding 50,000, then that is taxable, and if especially if the gift is to a non-relative. But in this case, the non-resident used to argue that I'm getting this gift outside India, so there is no basis to tax it in my hands because this is a gift outside India and the income doesn't accrue or arise in India. So a change was made in 2019. Now I think the government has realized that they only covered non-residents. They did not cover not ordinarily residents in this clause. So now they have also covered not ordinarily residents in this clause. So even if a NOR receives gift outside India from a resident, he will also be taxable if the amount exceeds 50,000. And obviously the NOR is a non-relative. Couple of things I've already covered here. Yeah, this is an important one. Cost of acquisition of intangible assets shall be nil. So if we recall in section 55, self-generated goodwill cost was clearly defined to be nil a couple of years back, but they did not define what would be the cost of acquisition of intangibles or a software that you may have developed or all that. So there also now they have clearly defined that if it's a self-generated software or an intangible asset or any other right, then that the cost for such an asset will also be nil. So what was happening was a lot of people were, especially in a startup environment, a lot of people developed software or tech and intangibles, right, and sold them to other players, and they would go and argue that my intangible assets cost cannot be determined because it is indeterminate, and therefore if the cost cannot be determined, you cannot compute the capital gains because capital gains is sale proceeds less the cost, and if the cost is indeterminate, capital gains cannot be determined. And if capital gains cannot be determined, you cannot tax me. This was based on an old Supreme Court decision in the case of BC Srinivasa Shetty. So this was the argument which was being taken. So I think in order to plug this, they have now clearly defined that even intangible assets and other rights which are self-developed, there also the cost of acquisition would be deemed as nil, so that you can now compute the capital gains.
Alok, in this example, what if the software company has been capitalizing some part of its salary on developers and other tech people, and they've been capitalizing for software development? So wouldn't that be a cost?
Yeah. So if you're capitalizing, not claiming it as an expense, obviously that will be a cost.
Okay. Yeah. So in your example, they were not capitalizing, and they're saying it's indeterminable to that.
Correct. Another small change that they've done is earlier, whenever a TP assessment used to happen, the TPO would ask for submission of the transfer pricing report or the transfer pricing study, right? And he would generally give a 30 days time to the SSC to furnish that report. And invariably, the SSC would also go ahead and ask or seek more time, and he would probably give another 30 days. And this was mentioned in the section. Now they have reduced the time limit, and they've said that at the first instance, he will give you only 10 days, and the maximum time that he will give you is only 30 days. So there was this thing which was happening where people were only taking a transfer pricing certificate in form CCEB, but we're not getting a TP study done, formal TP study done. And only when an assessment came, they started to put together a transfer pricing study, and obviously that took time. So now all those SSEs will have to be careful and have to make sure that the transfer pricing study is there in place, because otherwise they might find themselves in trouble on this. I think one important provision which they have brought in is, again, I mean, I don't know what is the exact reason. Maybe it's something to do with stay in India, make in India, or remain in India. They have introduced the hefty TCS on LRS, or a liberalized remittance scheme wherever you're making a payment other than for education purposes. So if you're making a payment other than for education purposes, beyond 7 lakh rupees, earlier there was a TCS of 5%. Now they are seeking to enhance it to 20%. This is effective 1st July 2023. And this is also applicable even if you're making payments for medical expenses to be incurred outside India, right? So that this is a little harsh provision, and this 20% is also applicable if you are undertaking an overseas tour or taking a overseas tour package and paying to a travel agent. Still, there is a 20% TCS. So there is a clear discouragement that that encourage tourism within India. Don't go and travel outside India. So I don't know. I mean, the earlier intention of introducing a TCS was to keep track, but now increasing it to such high rates, I mean, it just tells you that the government doesn't want you to spend money outside India as such. Okay. One good change that they've made is that a lot of times people find that their tax form 26AS gets updated after they file their tax returns, because some customers may have updated their withholding tax returns. And also there are cases where customers withhold tax in the subsequent year, while you may have accounted for that income in the preceding year. And it may so happen that you may have filed your tax returns and the time period for filing a revised return has also elapsed. So in that case, there was a genuine hardship for taxpayers as to how to claim that TDS, which you have already paid by way of advance tax or self-assessment tax, right? So now they have enabled that, and there is this section 155 subsection 20 where you can make an application. The only condition is that you have to showcase that you have offered that particular income for taxation in that year. And once you can showcase that, then the officer will pass an order to grant you the refund for that amount. I think, I mean, this amendment looks simple, but I think what we as professionals, what we'll need to now ensure more is that our 26AS entries are reconciled with what we show in our tax return, right? A lot of times people just claim whatever is appearing in form 26AS as a TDS. But I think there is an increased focus to reconcile the income which you have offered in your tax return and the TDS credit that you are claiming now. Online gaming has really taken off in the last couple of years, and there was a lot of talk about lack of clarity on what kind of TDS one should do or how's that taxable. So the government has introduced two sections, 115BBA and 194BB. One providing for taxability and other for TDS. And the government has said that if you earn or if your net winnings in a year exceed 10,000 rupees, then the online gaming platform has to deduct tax at the rate of 30%. So this is another change. Okay, life insurance premium. This is again, as I said, the government doesn't want to now give any benefits to industries as such through a tax law. And they have now said that if people are making huge life insurance premiums and then claiming the redemption of those policies later as exempt under 1010D, we will restrict this. So now the restriction is that you can only make life insurance premiums of up to only 5 lakh rupees. Beyond that, if you make life insurance premiums, then the receipts that you get are taxable and taxable as other income. So if you recall, a couple of years back, they had made a similar provision for ULIPs. There the limit was 2,50,000. But there the taxation was as per capital gains. But here in this case, they are taxing it as other income, which means the highest tax rate.
So Alok, here is this 5 lakh is per policy or 5 lakh is per assessee in a financial year?
So it is 5 lakhs in aggregate for all policies that you take. But this is grandfathered. So it won't apply to your old policies, but any new policies that you take after 1st April 2023.
But for example, policies come with all the different plans and maturities and returns, etc. Wouldn't it be very difficult, like the different policies with different tenures, and suppose the premium paid is say 6 lakh rupees, and then the returns are say when the policy matures, something is giving 20 lakhs, something else is giving 15 lakhs. How will all this be computed? Won't this really lead to a lot of confusion?
Yes, I mean, and in fact, they are going to come out with rules for this, similar to what they had come out for ULIPs also earlier. So they will come out with rules for this, and I think there will be more clarity once those rules come.
Okay, all right.
Another small change, they had introduced section 206AA and 206AB. Wherein they had said that if people are not filing their tax returns and their TDS exceeds 50,000 rupees, then they will be categorized as specified persons, and there will be a higher TDS or TCS required to be done. So government has realized that there are certain entities which are under law not required to file tax returns. So they've said that we will exempt those cases from a higher TDS or TCS.
All right.
That's there. And I think one small thing is in order to ease the pressure on the commissioner appeals of the cases which are pending before them, they have now also authorized the joint or created another post of joint commissioner appeals to handle low value appeals. They haven't prescribed what that value should be or what category of appeals he will handle, but they have enabled that provision under this budget. And also, I think for cost accountant friends, they have now enabled the assessing officer to approach a cost accountant to verify what is the inventory valuation, whether that inventory valuation is in line with the rules, because the government thinks that the people have been deferring taxes by playing with the inventory valuation at the year end. So that's another enablement which is there. So I think that kind of completes my part. If there's anything, I'll be happy to take up, clarify.
Sure. Thank you, Alok. There are a few questions in the Q&A box. If you can unshare your screen right now.
Yeah.
And what we'll do is I'll ask my team, let's give a 30 seconds voice rest to the speakers. And if my team can play a short introductory video about Complinity. it'll be nice, and then we'll pick up the Q&A very quickly and wrap up in 10 minutes or so. Yeah.
Welcome to Complinity Technologies. Complinity is India's leading governance, risk and compliance software helping companies to manage their compliance, contracts, litigation, legal updates, inter-financial controls and more. Complinity is a one-stop shop for all GRC needs. With our proprietary 12 GRC modules and real-time legal updates on 2,000 plus laws and 24,000 plus compliances, all in an integrated platform that is easy to use with automated alerts and risk management capabilities, is why compliance managers, general counsels and chief financial officers choose Complinity every time. Join the most innovative and prestigious brands that use Complinity. Automating your compliance management. Request a demo at complinity.com.
All right, thank you. So just to summarize, while tax is a very, I would say, difficult, for the one who are not tax practitioners, it's a very, I would say, one of the most difficult subjects in law, but made quite easy today by the speakers with the tax provisions that they said. So, and by the way, all the compliances, including tax laws, direct tax, indirect tax, customs, labor laws, in industry-specific laws, all the compliances, 24,000 plus compliances are covered in Complinity, therefore helping companies comply. So with real-time legal updates and dashboards and alerts, reminders, and all those capabilities. Let me just do one more poll. Give me a second. Okay, so if any one of you would like to have a demo of Complinity, please just indicate your preference here. So my teams will be happy to reach out to you. Yeah, I'll take 5 more seconds. If you could quickly indicate your preference. Okay, in that time, I'll launch one more poll if this poll is over on the budget. So quickly, if you could just indicate today, right now, if you would like to have a demo of Complinity, yes, no, or you already have one. Okay, in the meantime, let me ask a question to the speakers while they are doing this. So any one of you can answer this. Again, and if certain questions may be very broad, so you may take up one. So Prasoon says, is the government trying to curtail down investments? Because I think the Q is from removing of deductions or something like that. So is the government trying to curtail down investments, if that's the intention of the?
I think the thinking is that tax and investments are two different things. Because of tax reasons, you shouldn't be making investments. The investment decision should be independent of tax. If you're wanting to make investments, make investments. Don't use tax as a basis for making investments. Yes, there was forced investment on account of tax laws. But I think what the government is saying is, we will not influence your decision to make investment in only a product because there is a tax benefit there. Right? You go ahead and choose your best investment that you want to make.
Right.
That's my thinking of what government has in mind.
Right. No, totally agree. Another question asked by Ashwani is that, can you please elaborate on the amendment made in section 194R of the Income Tax Act in the budget? I'm not too sure if this is handy or if you could.
Yeah. So I think what they've done is they've made an amendment in section 28(4), and they've clarified that even cash given is a perquisite. Right. So there was a lot of debate whether cash per se can be a perquisite, because perquisite is generally understood to mean something which is non-cash and which only can be converted in money's worth or money's value. Right. And so people were taking a position that if I'm giving cash, then I'm not giving perquisite. Right. I think that has been clarified here. So that's the whole thing. 194R per se is a draconian kind of a provision. I think it will take another full session to go through the nitty-gritties, but this is what the amendment is in one hour.
Sure. Thanks, Alok. Next question from by Rakesh is, can you share list of eligible businesses of 44 ADA?
Yeah, so basically 44 ADA says that, any profession which is covered under section 44 AA is eligible profession, right? So it includes accounting profession, it includes legal profession, it includes medical profession, it includes interior decorator, it includes architect. So these kind of professions are included in that list.
All right, all right. Thank you, Balwan. And the next question by Rama is the government intending to continue rewarding inbound tour operators with SEIS benefits? Initial policy was for 5 years, 2015 to 20. Quite a specific question, if you can answer, yeah.
Right. So basically, this SEIS benefits have been, the scheme has been abundant, right? So in 2020, right? So like we don't think that this is going to come again, right? So it should not come again.
Understand. Okay, one more question by Ashwini. GST input on CSR spending has been specifically disallowed in the 2023 budget. Just wanted to know whether this will hit the bottom line of the corporate or reduce the actual CSR spending.
So one is definitely it is going to hit the bottom line, right? So till now, if you have spent 100 rupees and like 18 rupees was GST on that, so you used to take credit of those 18 rupees, right? Now this would also hit P&L, so it is going to definitely reduce profits. And actual spending on CSR is, I think that is a legal mandate, right? So one has to incur that expense, whether GST is there or not. I think it should not impact.
So just to my understanding, Balwan, on the same question, so if 100 is the CSR and 18 was a GST on that spend, was the entire 118 being counted as a CSR, or only 100 was counted as CSR in the first place?
So yeah, one is not a lot of people were taking credit on CSR spending, right? So if they would have taken GSTR credit, then in that case, 100 rupees was treated as CSR spending because 18 was available as credit. Yeah, to that extent, right? So like now that 118 would be counted as
CSR
spending, right? So to that extent, probably the CSR spending may be down.
Okay, okay. And I think one question from my side, any one of you can answer. Alok, you mentioned about the gaming industry, the change more than 10,000 rupee, it's taxable. No, I think the limit of 10,000 has gone. Any winning in the online gaming is taxable at 30%. But in the past, we've read news reports by the GST department launching huge demands, on the online gaming industry or certain players, saying that the entire receipt by the online gaming company is subject to GST or something like that. There were news reports. So I think that is that settled or that ambiguity still remains. So would you like to comment on GST on online gaming from a company standpoint, and any change in this budget on that?
So basically, Sumit, on GST aspect of online gaming, right? So there is a Supreme Court decision which says that only the commission or only the fees is subject to GST, right? Yeah, but we are aware that there are searches that is being conducted on these online companies. But I think after the Supreme Court decision, this is quite clear that GST should be applicable only on fee component.
Okay, okay, all right. Okay, I'll launch one poll on the budget. How would you rate this budget? Depending on whatever we have heard, the finance minister, there's a lot of provisions clarified today. We have been reading in newspapers and otherwise. How would you rate this budget in your own understanding, from 1 being lowest to 5 being highest? And I'll immediately after the poll, I'll ask the same question to the speakers as well as a wrapping up question. How would you rate the budget, and any concluding remarks? So let the audience just finish this poll, let us see what is the response of the audience. And while the audience is responding, the snippets of this webinar will be available on our social media channels, the link of which has already been shared by my team in the chat box. Please go ahead and subscribe to the YouTube channels, Instagram, Facebook, any other channel that you like. And, regular updates and collaterals will be shared, every week. So, okay, so on that, the poll says that 4% people feel it's 1, 4% 2. I think a good majority feels, 46% say it's a 3 budget, while 31% voting as 4 and 15% also voting as 5. All right, this is good. So my question to the speakers, one by one, if both of you could tell the audience or tell your views about, how do you rate this budget from 1 to 5 and why?
Okay, Balwan, go ahead.
So I think this is a good budget, right? Considering that there are not many doles, soaps doled in the doled here, right? So so election didn't have that much impact on the budget, right? And the major focus has been on investments in investment in infrastructure, right? So I think this budget has a focus on long term, right, instead of short term goals. So definitely, I think it's a good budget, and I should rate it 4 to 5 somewhere.
Sure. All right, Alok, your views?
Yeah, I think I kind of mirror the view of Balwan. Definitely a budget where things could have gone really wrong. In the hope to win an election, they could have done something which could have been detrimental to the economy in the long run. Thankfully, that has not been done, but at the same time, they also a feel good factor about this budget, because people, at least at the middle class or lower middle class level, have got something out of it. And then there are no wholesale sea changes which are there, so which would have given us a lot of headache. So we've saved from that as well. And the focus has been completely on infrastructure spending, and I think the government hopes that that will revive the economy further and create employment opportunities. I think the only thing I would want from the government is if they can implement some of the things they have already introduced in the past in letter and spirit both, right? For instance, I mean, I know for sure that commissioner appeals are pending for almost 3 years now, and hardly there is any movement there. The government has brought in another appellate authority to handle that, but how much does it help in tidying or in clearing the pending matters remains to be seen, because a lot of thing was said that there will be faceless appellate proceedings and all that, but that hasn't taken off yet. So I think if those things can be addressed, we should have a good year. Good year. And otherwise, from an intention point of view, I told you the 2 negatives for me in this budget. One, the angel taxation on non-residents, and the second is high TCS on LRS.
Right.
Other than that, I think it's been a good budget.
All right. So any rating, Alok, how would you rate it?
I would rate 4. Yeah.
Sure. All right. And, my 2 bits is that, of course, the tax proposals have been discussed in detail by Balwan and Alok, being tax experts. On the other hand, also, the overall direction seems to be startup friendly. Otherwise, minus this one hiccup, which I'm sure the government should listen, and as it goes to the parliament, certain changes are brought. But otherwise, broadly, the focus of the government seems to be towards the startups, towards the MSMEs, also towards green growth. There was, in the finance minister's speech, there was a lot focus about green growth and the whole the whole economy going towards the sustainable development, and also the capital outlay of 10 lakh crores, which Alok also mentioned in his presentation. I think that's a very welcome step, because through the capital expenditure there'll be a good positive spiral effect on the employment and infrastructure development and those kind of things. So net, even I would rate somewhere around 3.5, 4. Although 3.5 was not an option in the poll, but I, being the moderator, can exercise some moderator discretion as well. So on that note, I think let's end this webinar. It's been a wonderful webinar. Thanks Alok and Balwan again for sparing a valuable time. And again, I would say that it's been one of the unique webinars that we have done, where I was not expecting the budget webinar to be more like a tax masterclass. And you've really gone into the detail, into the sections, yet made it very, very simple. Tax being a very difficult subject. At least I was not, in my law and the CS days, I wasn't very, and I'm still not an expert in tax, but I think you made it quite simple. And thank you for all your time and sharing the expertise. And I'm sure the audience also would have liked it. So thank you, audience, for a patient hearing and for a great participation through polls and chat boxes and Q&A. Thank you, everyone, for this wonderful webinar.
Yeah, thank you, Sumit, for giving us this opportunity, and thank you to the wonderful audience and those wonderful questions.
Pleasure.
Thank
All
you.
right. Bye.
Thanks.
Thank you, everyone.
Welcome to Complinity Technologies. Complinity is India's leading governance, risk and compliance software helping companies to manage their compliance, contracts, litigation, legal updates, inter-financial controls and more. Complinity is a one-stop shop for all GRC needs. With our proprietary 12 GRC modules and real-time legal updates on 2,000 plus laws and 24,000 plus compliances, all in an integrated platform that is easy to use with automated alerts and risk management capabilities, is why compliance managers, general counsels and chief financial officers choose Complinity every time. Join the most innovative and prestigious brands that use Complinity. Automating your compliance management. Request a demo at complinity.com.